Ever dreamt of earning money while you sleep? Dividend investing could be your ticket to that dream. Imagine having your money work for you, even when you're not. No, this isn't some magic trick or get-rich-quick scheme. It's the world of dividend investing. This is where companies share a portion of their profits with their shareholders, and that's you. Dividends are like little thank you notes from companies, thanking you for trusting them with your hard-earned money. These notes can come in quarterly, semi-annual, or annual intervals, providing you with a steady stream of income. Now, you may be wondering, why dividends? Well, the beauty of dividends lies in their consistency. They offer a steady payout, even when the market is playing that roller coaster game. So, if you're tired of checking your portfolio every 5 minutes, and you're ready to wake up to a bank account that's grown overnight, stick around. Let's dive deeper into the world of dividends and discover how they can make your money work for you. So what exactly is this magical thing called a dividend? Well, let's break it down. A dividend is basically a portion of a company's earnings that is paid out to shareholders. Think of it as your slice of the company's profit pie. Tasty, right? Now how does this work? Well, companies that earn a profit can choose to do a couple of things. They can reinvest it back into the business, or they can distribute a part of it to their shareholders in the form of dividends. The amount each shareholder receives is proportional to the number of shares they own, but wait, there's more. We need to talk about something called a payout ratio. This is the percentage of earnings a company pays out as dividends. It's one handy little number that can give you a good idea of a company's dividend-paying capacity. In essence, dividends are your share of a company's success. Not too shabby, eh? Now, let's talk about the all-important dividend yield. This is a crucial metric for investors, serving as a compass to steer your investment decisions. So, what is it? Simply put, a dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's calculated by dividing the annual dividends per share by the price per share. Let's break it down with an example. If a company's annual dividends are $2 per share, and the stock is currently trading at $20 per share, the dividend yield is 10%. This means for every dollar invested, you would receive 10 cents in dividends. But here's the catch. A high dividend yield may seem attractive, but it's not always a good thing. It could indicate that the company is in trouble and the stock price has fallen. So, always remember to consider the whole picture. Remember, a high dividend yield isn't always a good thing. You've got to consider the whole picture. Now, let's dive into the real deal. Choosing dividend-paying stocks. It's like stepping into a candy store, but instead of sweets, we're looking for solid, reliable companies that consistently dish out dividends. First off, assess the company's financial health. You want to jump on board a ship that's not only sailing smooth but is also sturdy enough to weather any storm. Look at aspects like the company's debt levels, cash flow, and earnings stability. A company with less debt, positive cash flow, and stable earnings is more likely to pay consistent dividends. Next up is the payout ratio. This is the percentage of a company's earnings paid out as dividends. A low payout ratio might suggest that the company could increase its dividends in the future. But beware, a high payout ratio may look enticing, but it could be a sign that the company is stretching itself thin. Now let's talk about the company's history of dividend payments. Companies with a consistent track record of paying dividends are like those friends who always show up for you, rain or shine. You want those friends in your corner. A good track record gives you a sense of the company's commitment to returning profits to shareholders. Here's a pro tip. Look for companies that not only have a history of paying dividends but also increasing them over time. These are the real gems. They're like getting a raise without even having to suck up to your boss. And remember, investing isn't about putting all your eggs in one basket. It's about diversifying. So don't just go for the highest dividend yield. Mix and match. Choose stocks from different sectors. This way you'll have a safety net if one sector takes a hit. Choosing the right stocks is like picking the right lottery ticket. Only here you're relying on research, not luck. So keep these tips in mind, and you'll be well on your way to building a cash-generating portfolio. Alright, you've picked your stocks, now how about we build a castle with them? Think of your dividend portfolio as a medieval fortress. Each stock is a building block, and diversification is the architectural plan that ensures your castle withstands any siege. Now let's get into it. Diversification in the simplest terms means not putting all your eggs in one basket. It's about spreading your investments across various sectors, company sizes, and geographical locations. This approach can help you reduce risk and increase potential returns. Imagine if you invested all your money in one sector, say, technology. If that sector takes a hit, your portfolio would tumble down faster than a sandcastle at high tide. But if you've spread your investments across multiple sectors, technology, healthcare, consumer goods, utilities, and so forth, a decline in one sector may be offset by gains in another. It's a bit like a financial seesaw. Now let's talk about company sizes. Investing in both large, established companies and smaller, growing ones can provide a balance of stability and growth. Think of the large companies as the sturdy base of your castle, providing consistent dividends. The smaller companies, on the other hand, are the towers reaching for the sky. They may not provide hefty dividends right away, but their growth potential could lead to higher payouts in the future. Geographical diversification is another crucial aspect. Investing in companies from different countries can help you benefit from global growth and protect your portfolio from regional economic downturns. It's like having allies in different kingdoms, ensuring your castle's safety even if trouble brews at home. Remember, diversification isn't about randomly picking stocks from different sectors, sizes, and locations. It's a strategic process. Research each stock thoroughly, understand its potential, and consider how it fits into your overall portfolio. Just like a well-balanced diet, a well-balanced portfolio keeps your financial health in check. So take the time to build your diversified dividend portfolio. It's not just about building a castle, it's about creating a fortress that can weather any storm. Beware of the pitfalls, my friends. They're sneaky and often disguised as glittering opportunities. Now let's tackle the common missteps that beginner dividend investors often stumble over. First off, the allure of high yields. Yes, they can be as tempting as a chocolate cake at midnight, but remember, high yield is often a sign of high risk. It's like a shiny apple with a worm inside. Companies with extraordinarily high yields might be facing financial troubles, and that dividend could be cut faster than you can say, capital loss. So don't let the glitter blind you. Always do your homework and look beyond the yield. Next up, the sin of not diversifying. Picture this, you're at a buffet, and you fill your plate with only mashed potatoes. Sure, they're delicious, but there's a whole spread out there. Similarly, investing all your money into one or two dividend stocks is risky. Diversification is the spice of investing life. It helps to spread the risk and gives your portfolio a fighting chance against market volatility. So mix it up. Go for companies from different sectors with different risk levels and dividend yields. Last but not least, ignoring company fundamentals. It's like dating someone solely for their looks without considering their character. A company's dividend yield might be attractive, but what about its debt levels, its earnings growth, its payout ratio? These are the fundamentals that tell you whether the company is stable and profitable. They're the indicators of whether the company's dividends are sustainable in the long run. So don't just swipe right on the pretty face. Go through the company's profile, its financials, its track record. To sum it up, avoid chasing high yields blindly. Diversify your investments, and don't overlook the company's financial health. Remember, if it seems too good to be true, it probably is. So invest wisely and let your dividend journey be fruitful and rewarding. So there you have it, folks, dividend investing demystified. We've journeyed through the intriguing world of dividend investing together, from understanding what a dividend is to unmasking the secret behind dividend yield. We've delved into the art of selecting dividend-paying stocks and building a diversified dividend portfolio, and yes, we've even battled common pitfalls along the way. Remember, the beauty of dividend investing lies in its potential for regular income and the magic of compounding. It's about being patient, methodical, and consistent. It's about making your money work for you. Dividend investing isn't a get-rich-quick scheme, but a steady and strategic approach to wealth creation. But hey, don't just take my word for it. Give it a shot. Start small, learn as you go, and watch your wealth grow over time. If you found this video helpful, make sure to subscribe to our channel for more investing insights. And remember, your wealth is in your hands.